While the entire world was distracted by the theatrical geopolitical drama surrounding Greenland, while social media was consumed by debates about territorial sovereignty and underwater cable sabotage, something far more consequential happened in the deepest machinery of the global financial system. It was a signal so subtle that most market participants missed it entirely. But for those who understand the language of central banking, it was the equivalent of an air raid siren. Mark here from Go Finance, and what I'm about to show you in the next 35 minutes is not speculation. This is not conspiracy theory. This is documented historical precedent meeting current economic reality. And the convergence of these two forces suggests we are weeks, possibly days, away from the most significant coordinated currency intervention since 1985. On Friday, January 23rd, 2026, at approximately 10 o'clock a.m. Eastern Standard Time, something unusual happened on the trading floors of the major Wall Street banks. JP Morgan in Manhattan, Goldman Sachs at 200 West Street, Citigroup's Forex desk in London. These floors are always chaotic. Hundreds of traders screaming into phones, algorithms executing millions of transactions per second, screens flashing red and green with every tick of the market. But then the red phones rang. Not the regular trading lines, the red phones. These are dedicated circuits, direct lines, the kind of phones that only ring when something significant is about to happen. And the caller on the other end was the Federal Reserve Bank of New York, specifically the open market trading desk, the people who actually execute Fed policy in the currency markets. The question they asked was simple, almost mundane in its phrasing. What is your current price for USD JPY? Now, to someone unfamiliar with how central banking actually works, this sounds routine. It sounds like a bureaucrat checking a spreadsheet. But in the high-stakes, high-paranoia world of institutional currency trading, this type of call has a very specific name. It's called a rate check, and it is never, ever routine. Let me explain why this matters. The New York Fed does not need to call a dealer to ask for a price. They have Bloomberg terminals. They have direct feeds from the EBS and Reuters matching systems. They know exactly what the USD JPY exchange rate is at any given moment down to the fifth decimal point. They can see the bid, the ask, the volume, the order flow, everything. So when the Fed calls a primary dealer and asks for a price, they're not seeking information. They are sending a message. And that message is, we are about to intervene. We are checking liquidity depth because we are preparing to enter the market with massive size. We are preparing to sell dollars and crush the exchange rate. This is the financial equivalent of racking a shotgun slide in a dark room. It's a sound that means action is imminent. It's the universal code among central bankers and primary dealers that intervention is coming. The traders who answered those phones on Friday morning understood immediately what was happening. And according to sources I've spoken with who work on these desks, the response was visceral. Blood pressure spiked. Adrenaline flooded. Because a Fed rate check means one thing, get ready. The game is about to change. Now, before we go any further, I need you to understand the gravity of what I'm describing. This is not about day-to-day market volatility. This is not about the dollar going up or down a few percentage points based on inflation data or employment numbers. What we're discussing is a coordinated, deliberate, policy-driven devaluation of the US dollar. A reset, an engineered crash, designed to solve problems that cannot be solved any other way. And the reason I know this is coming, the reason I'm recording this video right now, is because we have seen this exact playbook before. We have seen this exact signal before. And when that signal was given in the past, it preceded the most dramatic currency intervention in modern history. To understand what's about to happen to your savings, your purchasing power, and every dollar-denominated asset you own, we need to go back 40 years. We need to go back to September 22nd, 1985. We need to go back to the Plaza Accord. In 1985, the United States was facing a crisis that is almost identical to what we're facing today. The US dollar was too strong. It had been rising for years, and that strength was crushing the American economy. US exports became uncompetitive because they were too expensive for foreign buyers. American manufacturing giants like Caterpillar, Ford, and IBM were hemorrhaging market share to Japanese and German competitors. The trade deficit exploded. American workers were losing their jobs. Factories were closing. The Rust Belt was forming. And Congress was going absolutely insane. Politicians were demanding tariffs. They were demanding protectionism. They were threatening to blow up the global trading system to save American jobs. Sound familiar? It should. Because we are living through the exact same script in 2026. So what did the government do in 1985? They couldn't just sit back and let the economy implode. They couldn't let Congress start a trade war. They needed a solution. And the solution they chose was radical. They chose to kill the dollar. On September 22nd, 1985, the finance ministers of the G5 nations met in total secrecy at the Plaza Hotel in New York City. The United States, the United Kingdom, France, West Germany, and Japan. In a smoke-filled room, behind closed doors, they agreed to a coordinated intervention to crash the value of the US dollar. They didn't announce it ahead of time. They didn't warn the markets. They just did it. And the impact was immediate and catastrophic for anyone holding dollars. The dollar crashed 50% over the next 2 years. 50%? If you were holding cash in 1985, you lost half your purchasing power by 1987. Half. But here's what's critical to understand. The Plaza Accord wasn't a failure. From the perspective of the US government, it was a massive success. It solved the trade deficit problem. It saved American manufacturing. It reset the global financial system. And it did all of this by sacrificing the currency. The people who got destroyed were savers, people holding cash, people holding bonds. The middle class who had their wealth stored in dollars, they got crushed. Their purchasing power evaporated. But the government survived. The system survived. And that's all that mattered. Now look at 2026. The parallels are not just similar, they are terrifyingly exact. We have a super strong dollar that's crushing US reindustrialization efforts. We have a massive trade deficit. We have unpayable sovereign debt. We have a collapsing Japanese yen threatening to destabilize Asian bond markets. We have Congress screaming about tariffs. And now we have the Fed making rate check calls to primary dealers. This is not a coincidence. This is the setup for Plaza Accord 2.0. And the phone call on Friday was the opening move. Before I continue, I need you to do something. Hit that subscribe button right now, because what I'm about to explain is not being covered by mainstream financial media. CNBC is not connecting these dots. Bloomberg is not showing you the historical precedent. They're going to tell you the dollar's fine. They're going to tell you to stay calm. They're going to tell you this is just normal market activity. But Go Finance is showing you the real machinery, the real playbook. And if you want to understand what's coming before it's too late, you need to be here. Drop a comment right now. Just type Plaza Signal. Let me know you're paying attention. Let me know you see what's happening. Because the people who understand this signal are positioning themselves right now, and the people who ignore it are about to get wiped out. Now let me show you exactly how the Plaza Accord worked. Because they are going to run the exact same play in 2026, just with bigger numbers, higher stakes, and far more violent consequences. The Plaza Accord didn't happen in one day. It happened in 3 distinct phases. And understanding these phases is critical because we are currently in phase 1 right now, and phase 2 is coming fast. Phase 1 is what I call the jawbone. This is the psychological preparation phase. This is where central bankers and treasury officials start changing their language. They stop saying, a strong dollar is in America's interest. They start talking about global imbalances. They start blaming the strong dollar for economic problems. They start hinting that something needs to change. In early 1985, before a single dollar was sold, the intervention began with words. Treasury Secretary James Baker and Fed Chairman Paul Volcker started leaking carefully crafted concerns to the financial press. They stopped defending dollar strength. They started questioning it. This is exactly what we're seeing today. The White House is complaining about currency manipulation. The Treasury Department is focused on the trade deficit. There's suddenly massive attention on tariffs, on foreign nations not consuming enough American goods, on the strength of the dollar making U.S. exports uncompetitive. These are not isolated policy discussions. This is the jawbone. This is the setup. This is the psychological conditioning of the market to accept what's coming next. And the rate check on Friday represents the escalation of the jawbone. It moves the threat from words to action. It moves from the podium to the trading desk. It's no longer just talk. It's kinetic signaling. Phase 2 is what I call shock and awe. This is the actual intervention. This is when the central banks stop talking and start acting. And when they act, they don't act gently. They act with overwhelming force. On September 23rd, 1985, the day after the Plaza Agreement was signed, the central banks didn't nudge the market. They kicked the door down. The Federal Reserve, the Bank of Japan, the Bundesbank, the Bank of France, and the Bank of England all entered the foreign exchange market simultaneously. They dumped billions of dollars. They sold dollars and bought their own currencies. The impact was immediate. The dollar dropped 4% in a single day. 4% might not sound like much, but in the currency markets, that's an earthquake. That's a once-in-a-decade move, and it happened in one session. Traders who were long the dollar, who had been betting on dollar strength for years, who had made fortunes on the long dollar trade, were massacred. Their positions were wiped out. Margin calls flooded in. Hedge funds blew up. The trade that had been a sure thing for 5 years became the widowmaker overnight. We are likely weeks, possibly days away from this moment in 2026. Imagine waking up on a Monday morning to headlines that the Federal Reserve, the European Central Bank, the Bank of Japan, and the Bank of England have all issued a joint statement on exchange rate stability. Imagine seeing the dollar index gap down from 106 to 95 in a matter of hours. This is not a gradual decline. This is a step function. This is a repricing event. and it forces every hedge fund, every pension fund, every corporation holding long dollar positions to liquidate in a panic. That panic selling creates a feedback loop that drives the dollar even lower. It's a controlled demolition, and the Fed will be the one pressing the detonator. Phase 3 is the managed decline. After the initial shock and awe, the central banks don't just walk away and let the market find a new equilibrium. They manage the decline. They put a ceiling on the dollar. Every time the dollar tries to rally, they sell into it. They force it down step by step, month by month, for years. From 1985 to 1987, the dollar fell from 260 yen to 130 yen. It lost half its value against the Japanese currency. It fell from 3.3 German marks to 1.6 marks. For American tourists traveling to Europe or Japan, it was a disaster. Everything became twice as expensive. Hotels, meals, souvenirs. It was a 50% haircut on the global purchasing power of American savings. But here's the critical part. Here's the part that mainstream media will never explain to you. While the dollar was crashing, while American savers were getting crushed, the U.S. stock market was exploding higher. The S&P 500 roared in the late 80s. The Dow Jones Industrial Average went vertical, and financial commentators celebrated it as a bull market. They told investors they were getting rich, but it was an illusion. It was a nominal illusion. The stock market went up in dollar terms, but the dollars were worth less. You made money in your brokerage account, but that money bought less stuff from abroad. Your net worth number went up, but your actual purchasing power went down. This is the trap. This is the mechanism of the wealth transfer that most people never understand until it's too late. The government saves itself by inflating away the debt. Manufacturing gets a boost because weak currency makes exports competitive. But the middle class gets crushed by the cost of imports. Electronics, cars, oil, coffee, everything you buy from abroad becomes massively more expensive. This is imported inflation. This is the trade-off the elites made in 1985. And it's the exact same trade-off they're making right now in 2026. They are choosing to sacrifice the purchasing power of your savings to save the solvency of the U.S. Treasury. They are choosing to make you poorer to keep the government operational. And the rate check signal tells us the decision has been made. The architects have looked at the debt spiral. They've looked at the interest payments. They've looked at the mathematical impossibility of the current path. And they've decided that the only way out is to crash the currency. Now let me show you the math, because this is not about politics. This is not about left versus right. This is pure mathematics, and the mathematics are terminal. The United States currently has $36 trillion in sovereign debt. 36 trillion. That is not just a big number. That is an existential number. For years, when interest rates were at 0%, this debt load was manageable. The interest payments were negligible. The government could service the debt easily. But everything changed when the Federal Reserve raised rates to fight inflation. Interest rates went from 0 to 5%, and when you're carrying $36 trillion in debt, that rate increase doesn't just hurt, it kills. At 5% interest, the annual cost to service the national debt is approximately $1.8 trillion. $1.8 trillion, just to pay the interest, not to pay down the principal, just the interest. Let that number sink in for a moment. $1.8 trillion per year. That is more than the entire Social Security budget. It is more than the entire defense budget. It is more than Medicare. It is the single largest line item in the federal budget, and it's growing. The U.S. government collects about $4.5 to $5 trillion in taxes annually. If nearly $2 trillion of that goes to interest payments, there's almost nothing left for everything else. Roads, schools, military, police, the entire social safety net, everything. The government is now borrowing money just to pay the interest on the money it already borrowed. This is the textbook definition of a Ponzi scheme. And like all Ponzi schemes, it works until it doesn't. It works until the new money stops coming in. And that's where we are. Foreign buyers are slowing their purchases of U.S. treasuries. China has been reducing its holdings. Japan is facing its own debt crisis. Europe is dealing with negative growth. There's no cavalry coming. The new money is drying up. So the U.S. government has three options. There's no fourth. There's no secret alternative. Just three paths. And two of them are politically impossible. Option one, austerity. The government cuts spending by 40% to balance the budget. This means slashing Social Security, cutting the military in half, firing millions of government workers, eliminating entire federal agencies. This is politically impossible. No politician will ever vote for this. It would cause riots in the streets. It would cause a revolution. It's not happening. Option two, hard default. The United States simply stops paying its debts. They tell China, Japan, and American pension funds, sorry, we're not paying you back. This is geopolitically impossible. It would cause World War III. It would destroy the global banking system instantly. It would end the dollar as the reserve currency overnight. It's global suicide. Option three, soft default through devaluation. The Federal Reserve intervenes in the currency markets, prints new dollars, and deliberately lowers the value of the dollar. They pay back the $36 trillion, but they pay it back in paper that's worth 50% less than when they borrowed it. Option 3 is the only viable path. It's the path of least resistance. It's the path governments have chosen throughout history, from Rome to Weimar Germany to the Plaza Accord. This is the exit strategy, and the rate check confirms they're activating it. By coordinating a global devaluation of the dollar, with allies like Japan and Europe, who also need to debase their currencies to manage their own debt loads, the US achieves 3 critical strategic goals. Goal 1, inflating away the debt. If the dollar loses 50% of its value and inflation runs at 5 to 10% for 5 years, the real burden of that $36 trillion debt falls dramatically. The nominal number stays the same on paper. It still says 36 trillion. But relative to GDP, which rises with inflation, the debt becomes manageable again. This transfers massive wealth from creditors to debtors, from China, Japan, and American savers to the US government. It's a stealth tax on anyone holding dollars. And it's completely legal because you can't sue the government for inflating. Goal 2, the reindustrialization strategy. President Trump and the populist movement want to bring manufacturing back to America. They want made in USA to mean something again. But you can't do that with a strong dollar. If the dollar is strong, American labor is expensive compared to Mexican or Vietnamese labor. American products are expensive on the global market. Nobody buys them. But if the dollar crashes by 50%, suddenly American labor becomes cheap on the global stage. German and Japanese companies will build factories in Ohio and Michigan, not because they love America, but because it's cheaper than building in Munich or Osaka. A weak dollar is the ultimate tariff. It makes imports expensive, protecting domestic industry. It makes exports competitive. It's the only way to reshore supply chains without causing a depression. Goal 3, saving the banking system. The U.S. banking system is currently sitting on hundreds of billions of dollars in unrealized losses on their bond portfolios. When the Fed raised rates, bond prices fell. That blew a hole in bank balance sheets. We saw this with Silicon Valley Bank. If the Fed intervenes to weaken the dollar, they typically do it by printing new dollars to buy foreign currencies. This injects massive liquidity into the system. It's quantitative easing by another name. And that liquidity flood lifts asset prices. Stocks go up, real estate stabilizes, bonds recover, bank balance sheets heal. This bails out the system at the expense of the currency. It saves the banks by destroying the purchasing power of your savings. The rate check signal tells us the decision has been made. The architects have chosen soft default over hard default. They're going to crash the dollar to save the system. And they're hoping that by doing it in coordination with Japan and Europe, they can control the explosion. But history shows that once you start a currency avalanche, you can't control where it goes. Now let me show you what happens to different asset classes when a coordinated devaluation occurs, because understanding this is the difference between protecting your wealth and watching it evaporate. When the Plaza Accord crashed the dollar in 1985, different assets responded in completely different ways. Some went to zero, some went to the moon, and the pattern is repeating right now. Cash got obliterated. If you were holding cash in 1985, you lost 50% of your purchasing power by 1987. Cash is a guaranteed loser in a devaluation. It's like holding an ice cube in a warm room. It melts, and there's nothing you can do about it. Long-term bonds were dangerous. As the dollar fell and inflation rose, bond yields had to rise to compensate investors for the loss of purchasing power. Rising yields mean falling bond prices, so bondholders got hit twice. Once by currency devaluation, twice by capital losses as prices fell. But certain assets exploded. Gold began a massive multi-year bull market after the Plaza Accord. It repriced the devaluation. Why? Because gold is the direct inverse of dollar confidence. When the dollar is deliberately crashed, gold becomes the safe haven. It's the only asset with no counterparty risk. It's nobody's liability. In 2026, the reaction will be more violent because the debt levels are higher, the trust in the system is lower, and we have a new asset class that didn't exist in 1985. Bitcoin. Bitcoin acts as a high beta digital version of gold. It's a bearer asset that cannot be diluted by the Fed. It's the fire alarm for fiat currency collapse. When central banks coordinate to debase their currencies, capital floods into Bitcoin because it's the only truly scarce digital asset. You need exposure to both. Gold is your defensive position, your insurance. Bitcoin is your offensive position, your asymmetric bet. Do not choose. Own both. U.S. stocks went vertical after the Plaza Accord, but it was a nominal illusion. The Dow Jones went from 1,000 to 3,000. People felt rich. But those gains were in dollars that were worth half as much. Your portfolio value doubled, but your purchasing power stayed flat or even declined when you factored in import inflation. This time will be the same. Stocks will likely rise in nominal dollar terms. Financial media will celebrate it. But you're not actually getting richer. You're just keeping pace with currency debasement. The real winners will be companies that export or produce commodities. Commodity prices exploded. Oil, copper, wheat, corn, all priced in dollars globally. When the dollar falls, it takes more dollars to buy a barrel of oil or a ton of copper. This is mechanical. If you owned energy producers, mining companies, or agricultural businesses during the Plaza Accord, you made fortunes. Real fortunes, not nominal illusions. Emerging markets boomed. When the dollar is strong, emerging markets suffer. They have dollar-denominated debt that becomes expensive to service. Their economies are strangled. But when the dollar crashes, the pressure comes off. Their currencies rise. Their debt becomes manageable. Their economies grow. Their stock markets outperform. Brazil, Mexico, Vietnam, Indonesia. These markets will be massive beneficiaries of a weak dollar regime. Capital will flood out of the US and into high-growth, commodity-rich, emerging economies. Now let me show you the 4 protocol rules for positioning before the reset. Protocol Rule 1, the hard rotation, gold, and Bitcoin. You must have exposure to both, not just one, both. Gold is your shield, Bitcoin is your spear. Allocate at least 10 to 20% of your liquid net worth to this combination. If you wait until after the intervention is announced, the entry points will be gone. Central banks are already front-running this. China bought record amounts of gold in 2025. Poland, Singapore, Turkey, all adding gold aggressively. They see what's coming. Follow the central banks. Protocol Rule 2, emerging markets. The dollar short. Look for ETFs or direct exposure to commodity-rich emerging markets. Brazil for agriculture and oil, Chile for copper, Vietnam for manufacturing. These economies will boom as dollar strength reverses. Capital will flow out of the US in what I call the silent sale and into these high-growth markets. You want your money waiting there when the flood arrives? Protocol Rule 3, real assets, commodities. You must own the producers, energy companies, mining companies, agricultural businesses. When the dollar falls, commodity prices rise mechanically. If gas goes to $6 a gallon because the dollar crashed, your Exxon stock should double to offset it. If wheat prices rise, your fertilizer stock should rise. You turn your consumption liabilities into investment assets. You hedge your cost of living through your portfolio. Protocol Rule 4, audit your stock holdings. Avoid importers, long exporters. You must look at every company you own and ask, does this company rely on imports? If yes, avoid it. Retailers like Walmart and Target will get crushed by rising import costs. Tech hardware companies that manufacture abroad will suffer. Focus on U.S. companies that export. Boeing, Caterpillar, U.S. energy exporters, U.S. agricultural producers. These companies become competitive when the dollar falls. Their products get cheaper for foreigners to buy. Their earnings rise. This is the reindustrialization trade. Align yourself with the government's survival instinct. Now let me address the question everyone's asking. When exactly will this happen? When will they pull the trigger? The honest answer is, we don't know the exact date, but we know the conditions are in place. We know the signal has been given. And we know from history that once a rate check is issued, intervention typically follows within days to weeks, not months. The timing makes sense for several reasons. First, we're approaching critical debt ceiling deadlines. The U.S. government needs to refinance massive amounts of debt in the coming months. If they try to do that with a strong dollar and high interest rates, the math doesn't work. But if they crash the dollar first, inflation expectations rise, nominal GDP grows, and the debt becomes more manageable. Second, the Japanese yen is in free fall. USD JPY is approaching 160, which is a critical threshold. If the yen breaks through 160, it could trigger a cascade of liquidations in the Japanese bond market. That would destabilize all of Asia. The Fed knows they need to act before that happens. Third, the political window is open. Trump is back in office. He has made it clear he wants a weaker dollar to support manufacturing. The Treasury Department is aligned. Congress is focused on tariffs and trade. The political conditions for a Plaza 2.0 intervention have never been better. Fourth, foreign central banks are cooperating. Japan desperately needs dollar weakness to save the yen. Europe needs dollar weakness to boost their exports. China would benefit from reduced dollar strength, even though they never admit it publicly. The G7 finance ministers have been in constant communication. The coordination is there. So when you put all of this together, the window for intervention is right now. January to March 2026. This is the danger zone. Now let me show you what the intervention will actually look like when it happens, because understanding the mechanics will help you position correctly. The announcement will likely come on a weekend or holiday when markets are closed. This gives them maximum control. They'll issue a joint statement from the G7 finance ministers and central bank governors. The language will be carefully calibrated. They won't say, we're crashing the dollar. They'll say something like coordinated action to address global imbalances or supporting balanced economic growth. But the meaning will be clear. The central banks are intervening. They're selling dollars. And they're prepared to do it at massive scale. When Asian markets open on Monday morning, the dollar will gap down violently. We're talking 5 to 10% in the first session. Hedge funds will panic, margin calls will flood the system, long dollar positions will be liquidated at any price. The Fed will enter the market during U.S. trading hours and sell even more dollars. They'll overwhelm the market with supply. Anyone trying to buy dollars will be crushed. The message will be clear: don't fight the Fed. Don't fight coordinated central bank action. This initial shock will last 2 to 3 days. Then comes the managed decline. For the next 18 to 24 months, the central banks will maintain constant pressure. Every time the dollar tries to rally, they'll sell into it. They'll put a ceiling on dollar strength and force it lower step by step. Gold and Bitcoin will go vertical during the initial shock. Then they'll consolidate and grind higher for years. Commodity prices will spike immediately as traders price in the weaker dollar. Emerging market currencies will surge. U.S. stocks will be volatile initially, then rally hard as liquidity floods the system and earnings get boosted by export competitiveness. But remember, those gains are nominal. In real purchasing power terms, you're just keeping pace with debasement. The pain will be felt by ordinary Americans at the gas pump, at the grocery store, and when buying electronics or imported goods. Everything from abroad will become dramatically more expensive. This is the hidden tax. This is how the government transfers wealth from savers to debtors. Now let me address the skeptics, because I know some of you are thinking, this sounds like conspiracy theory. The Fed would never deliberately crash the dollar. That's insane. But it's not insane. It's history. They did it in 1985. They've done it multiple times throughout history. The Bretton Woods system, the Nixon shock, the Plaza Accord, the coordinated central bank interventions of the 1990s. Currency intervention is standard policy when the system is under stress. It's in the playbook. And the playbook gets used when there's no other option. The question is not whether they'll do it. The question is whether you'll be prepared when they do. Let me also address another objection. If this is so obvious, why isn't everyone talking about it? Why aren't there headlines on CNBC? The answer is simple. Most financial commentators don't understand central bank mechanics. They report on price movements. They don't understand the machinery underneath. And the people who do understand, the traders on the Fed's rate check call list, are not going on TV to warn you. They're positioning their books. Information asymmetry is how wealth transfers occur. The insiders move first, then the informed observers, then the general public. By the time CNBC is running headlines about coordinated intervention, the move is over. The entry points are gone. That's why we're doing this now. That's why GoFinance exists, to give you institutional level intelligence before the headlines hit. Now let me show you the most important part, how to actually implement the 4 protocol rules in your own portfolio. If you're holding significant cash right now, you need to reduce that exposure immediately. I'm not saying go to zero cash. You need some liquidity for living expenses and emergencies. But if you have more than 6 months of expenses in cash, you're taking unnecessary risk. Convert excess cash into hard assets. Gold, Bitcoin commodity producers, emerging market exposure. Do it systematically over the next few weeks. Don't try to time perfection. Just execute. If you own long-term treasury bonds, consider reducing that exposure. In a devaluation scenario, yields could rise as inflation expectations increase. Rising yields mean falling bond prices. You'll get hit twice, once by currency loss, once by capital loss. If you own dividend stocks or blue chip equities, audit them. Look at their revenue sources. Do they import heavily? Do they export? Do they have pricing power to pass through higher input costs? Position accordingly. If you're young and can handle volatility, increase your allocation to Bitcoin. This asset class didn't exist in 1985, but it exists now, and it's the highest convexity bet on currency debasement. If the dollar crashes 50%, Bitcoin could go up 10 times. The asymmetry is extraordinary. If you're older and focused on wealth preservation, increase your gold allocation. Physical gold, allocated storage, or high-quality mining companies. Gold won't give you 10 times returns, but it will protect your purchasing power when everything else is melting. If you have international flexibility, consider moving some assets offshore. Singapore, Switzerland, jurisdictions with strong property rights and stable currencies. Diversify your counterparty risk away from U.S. banks. Most importantly, do not panic. Coordinated devaluations create chaos in the short term, but they also create enormous opportunities for those who understand what's happening. The key is positioning before the announcement, not after. Let me bring this all together and show you what the next 6 to 12 months likely look like. We're currently in phase 1, the jawbone. The rate check was the escalation signal. Over the next few weeks, we'll likely see more verbal intervention from Treasury officials, more complaints about currency manipulation, more focus on the trade deficit. This is the setup. Then comes phase 2, the shock. This could happen any Monday morning. G7 announcement. Coordinated intervention. Dollar gaps down 5 to 10%. Chaos in the markets. Margin calls. Liquidations. Gold and Bitcoin spike. Commodity prices surge. This shock lasts a few days. Then comes phase 3, the managed decline. The central banks maintain constant pressure for 18 to 24 months. The dollar falls from 106 on the DXY index to 70 or 60. A 30 to 50% decline, exactly like the Plaza Accord. During this period, U.S. stocks rally in nominal terms. Financial media celebrates. Ordinary Americans feel rich looking at their 401k statements. But gas hits $6 a gallon. Electronics become unaffordable. Vacation to Europe costs twice as much. This is the hidden wealth transfer. By 2027 or 2028, the dollar stabilizes at a new, lower equilibrium. The debt to GDP ratio looks manageable again because nominal GDP has risen with inflation. The government has inflated away 30 to 40% of the real debt burden. Mission accomplished. Manufacturing returns to the United States. Factories reopen. Politicians claim victory. Made in USA means something again, but it came at a cost. The cost was your purchasing power. The cost was your savings. The cost was the value of every dollar you were holding. This is not speculation. This is the playbook. This is how governments escape unpayable debt loads without declaring bankruptcy. They debase the currency. They inflate away the debt. And they do it in coordination with other central banks, so no single currency takes all the pain. The Plaza Accord of 1985 solved the U.S. debt and trade problem of that era, but it created the Japanese asset bubble in the subsequent lost decades. It created massive distortions in global capital flows. The unintended consequences were enormous. The same will happen with Plaza 2.0. We can't predict every consequence, but we know the primary effect: dollar weakness, asset price inflation, imported inflation, wealth transfer from savers to debtors. So here's what you do right now, today, this week. Step 1, audit your portfolio. Calculate what percentage is in cash, bonds, stocks, hard assets, international exposure. Write it down. Step 2, reduce excess cash. Anything beyond 6 months of expenses should be redeployed into productive assets. Step 3, add gold and Bitcoin exposure if you don't have it. Even 5 to 10% of your portfolio in this combination will provide significant protection. Step 4, add commodity and emerging market exposure. These are the inverse dollar trades that win big in a devaluation. Step 5, review your stock holdings. Eliminate importers. Add exporters and commodity producers. Step 6, do not panic when the intervention happens. It will be chaotic. Markets will be volatile. Stay focused on the long-term positioning. The rate check has been issued. The Plaza 2.0 playbook is active. The architects have decided that the dollar must be sacrificed to save the system. And if you're holding cash, believing it's safe, you're standing directly in the path of an engineered avalanche. The New York Fed doesn't call primary dealers to ask for prices they already know. They call to send a message. And that message has been sent. The dollar is too strong. The debt is too large. The system is trapped. And the only escape is devaluation. This is not about politics. This is not about left versus right. This is mathematics. And the mathematics say the dollar must fall for the government to survive. The last time we saw this signal was September 1985. And what followed was the most significant coordinated currency intervention in modern history. A 50% dollar crash, a reset of the global financial system, and a massive transfer of wealth from those who didn't understand what was happening to those who did. History isn't repeating, it's being reused. Same playbook, bigger numbers, higher stakes. The choice is yours. You can ignore this signal. You can hold cash and hope I'm wrong, or you can position defensively, protect your purchasing power, and potentially profit from the reset. Mark from Go Finance. The Plaza signal has been given. The protocol is active. Don't say you weren't warned. If you found value in this breakdown, hit that like button. Drop a comment with Plaza signal so I know you're paying attention. Subscribe if you haven't already. And share this with anyone who needs to understand what's coming. This is not entertainment. This is real-time intelligence on a coordinated devaluation that will reshape global wealth. The clock is ticking. Position accordingly.